wanted to ask you about sort of a phenomenon. You kind of talked about it a little bit there, but I'm curious how you see this playing out, because it seems like over the last decade there's been a lot of cap rate compression, which for people listening to this, the cap rate is basically the percentage return that you can expect before you put any financing on a property. And so as those, it made sense that those are going down as the market improves. The returns overall are compressing, but interest rates were going down with them. Now we just hit a record high interest rate since 2002, and it seems like in a lot of markets the interest rate exceeds the cap rate, which means once you put financing on it, you're actually losing money every month and have negative cash flow. So how does that work? I mean, how do all properties in those markets then, like, they just reset in terms of pricing, or are people still buying those, or how does a multifamily investor deal with this phenomenon?
Yeah, it's a very interesting point, and we just sold a property a couple months back, and we sold it at a 4.2% cap rate for a C-class property. That's extremely low. That means we got a really good price for it, for the property. And that investor purchased from us the year before, and they have their own management company and stuff like this, but they're still probably paying somewhere in the fives for that debt. So they're losing on that in the short term. However, they're able to purchase the property, and they're what we call, that's a consistent buyer, and that's something like that we would consider ourselves. They're always looking to buy. They're always looking to increase their footprint in an area, and that drives down their costs as well. But for their situation, since they already had units before, they bought properties at the top of the market last year from us, and they want to buy this one. And once they came to a number with us, we sold it to them, and we were going to hold on for a couple of years, but the numbers worked out and we sold it. And so when you have this differentiation between the interest rates and the cap rates, it really depends on what the underwriting, how you can work and structure the underwriting. And for anybody reviewing a deal, especially if you're a limited partner, you really have to understand exactly what this business plan is. And when I say the business plan, it's really, what is the plan for this operating group, this operator, this general partners, to take this property from where it is here to where it needs to go to get these returns. And it can be, usually what we're looking at is, we want to look, the main high level is, when you're looking at this, is trying to find a comparable property, so similar vintage, so built in around the same time, similar size units, similar amenities, and we want to see exactly something where their rents are, if they've had any work done to their property, and where ours could. And we really want to see something where our rents could really go up 25% to 30%. And that's not right away. That's after we do work to the property. That's after a lot of deferred maintenance on the property has been taken care of. Because once you own property for a while, owners get lazy. And it's happened to me before, and it happens to a lot of owners. Mainly with mom and pop owners. And it's something where, hey, everybody's paying. I'm paying down my debt. I got this fixed rate on my debt. There's no problems. Everything's going great. And then you have an investor looking and go, yeah, we're getting $1,000 a unit. Down the street, this person just did this and that, and they're getting $1,350 for their units. And so that investor comes in and is going to willing to overpay if that's a really good property, and buy that property in the hopes of maybe being able to raise that rent closer once they've done the work and they've corrected a lot of issues that maybe were just patched. You know what I mean? So the place has to be painted. No, they're just they're doing one thing at a time. You know what I mean? Or landscaping's kind of shoddy. Or they just won't fix this pool correctly in our amenity section. You know what I mean? Or these doors just don't close going into the workout club zone. So it's all these things that have to be taken care of, and do a facelift and invest money into it. And that's where the new business plan comes in and tells you exactly what they're going to do to get those values up. And this is where you're able to find out from competitors and find out from other comps in the area, rental comps in the area, if you can get there. And having that business plan that allows them that road to getting to those higher rents. And that's what, in the short term, yes, you're going to be losing on that little bit of time there. But the other thing too is, when you're going into it, it's not all about just raising rents. You're also going to be fixing a lot of mismanagement on the property. So we're always going in and changing management on the property. We're always getting rid of expensive vendors. So we took over a property a couple years back, and I remember our trash vendor was literally half as much as theirs. So these things like this, nobody's rent has to go up for these to be changed, and these can be done right away. So you can go in there and fix some of those inefficiencies. That's going to increase your NOI, your net operating income right away. And that's going to kind of close that gap just a little bit. And then you're going to go in and start going through and doing the renovations to the properties, and that's going to help do it. It's important that your investors know that this isn't like, hey, we're going, within a few months, we're going from 1,000 to 1,350, a month in rents. It's going to be, hey, this is going to be a 2 or 3 year process. You know what I mean? We've got 50 units we're going through. We're going to do 1 or 2 units per month or whatever it is. And this is how the plan is, so that in 2 or 3 years, we can refinance it or we can sell it. And then that's where we're going to get it. And that way, because you're going to have tenants in there that you're going to resign. You want to keep them. You're going to have troubled tenants that have to go. So the first really 6 months I call like the initial stabilization, and that's where you're really finding out exactly the true story. You have a very good idea, but now you're really finding out the true story. You're putting in new management, you're taking care of problems, putting in new vendors, putting in new contractors, new managers, and then that's where you're coming in and really starting the process. And if your numbers work out where you can do that with some sort of float, that's where it makes sense. The problem is that people come in there and their comparables are something like 3 miles away, and they're saying, oh, we can take this 1,000 units and go to a 1,500, and you're like, well, that property's 20 years newer, it's got this, it's got that, it's a better area, and that's where the problems start, because now it's, you did buy it underpriced, but 1,000 goes to 1,125, you're not going to be able to make up, you know what I mean? You're not making up that. You really have to see a route to getting those rents in 2 or 3 years up 20-25% while you're doing work to the property, and you're going to keep tenants. Trouble tenants are going to move out, some other tenants are going to move out, you're going to move good tenants in there, and you're going to have a very stabilized property in 3 or 4 years.
That makes a ton of sense. Yeah, so it's all about the operations of the property and improving those, and that's where you make up that difference and how you can make deals still work today. Right. That's interesting. Can you give me an example? Can you walk me through like maybe one of your more recent deals and what it looks like in terms of type of property, location, the numbers on it?
Yeah, so I will talk about, so we have a property we purchased, our last property we purchased was at the day before Thanksgiving 2022, and it's 536 units in Dallas, huge deal, our biggest one we've ever done.
Wow.
And on that property, we built in 1985, it's about a 15-minute drive from downtown Dallas, and we put it under contract at about $111,000 a unit. We were able to renegotiate after doing the walkthrough to about $109,000, which is very low for that. That property would have sold probably in 2021 for probably $125 a unit. So seeing those kind of discounts there, and we had already gone through massive interest rate increases, so we already kind of knew where we stood with that, even though they've gone up like another 1.5% since then. But it's something that we have an interest rate cap on that. But at that point, what we've already done, the work we've already done on that property, is that we've taken it and we've right now it's occupied about 92%. The rest of the units we have a small part of that that's being rented, and the rest of them is that we're doing work on there, and we're renovating about 15 units per month, 15 to 20 units per month, and then we're renting out the other ones, and so it's a lot of work, and it takes about 2 weeks. How our crew's working, they're like doing 2 weeks. It's 2 general contractors with multiple crews that are there. But so we're doing a lot of them, but also the turnover that we have is much higher than that. So it's really it's really kind of a craft of really how you're going to keep enough units for them to be renovated, but also how can I keep that, the magic number in multifamily is like 90%, right? We don't want it to go into the 80s. 80s is much different from the 90s. You really want to keep it 90% higher of people in there, and then of those people, you really want to get that as high as possible, so you really have like 88% of your units paying rent on time, all this kind of stuff, and that means that all your expenses are going to be paid plus more, so you can still, we still just put out distribution to our investors, our first one. But the thing though is that we're able to do all of that, but we're also making progress on the renovation portion, which is really going to raise the net operating income over the time. And I think when we purchased that property, it was like the average rent was like $1,050, and now it's about $1,100. So these aren't massive increases we're doing overall the whole property, but that means we're making changes to the property. We're able to get the expenses down a little bit, and having a minor increase like that, especially in a super hot market like Dallas, that means that we're keeping tenants there. And then when tenants come up to their, coming up and say, do you want to stay? If you want to stay, the new rent's going to be, say, $10.75, whatever it might be. You stay in the same unit. We have upgraded units that you might want to move into. Those are $1,200, $1,250, whatever they might be. You can move into that unit, whatever you like to do. And you offer this, so hopefully you can keep some of your tenants, your good tenants. They have the option of, yeah, I do want to go to a better unit. I do want to stay here. I have friends and family here, and it's close to my work. So I'll just move over here to this other one, and I can just move in right away. There's no issues, right? So these are the different options, how we're trying to keep good tenants in properties, how we go into them, and how we try to work with everybody there to keep people there, but also to put new tenants in as those units come up, because there might not be as many people wanting to move into the new ones. They want to stay at the classic, unupdated unit that they have.